Okay guys, so first and foremost, what you have to do is to subscribe to this channel for more videos on accounting, financial reporting, financial management, audit and assurance, anything. Subscribe to this channel, like, comment, and then you share. So I'm here to show you how to account for leases, IFRS 16, that is leases, and it is very simple and straightforward. So now when we talk of a lease, what do we mean by a lease? Now according to IFRS 16, a lease is a contract that conveys or give the right to use an asset for a period of time in exchange for a consideration. That's all, we are done. That's all. A contract that conveys or gives the right to use an asset. So first keyword, the right to use an asset. Second keyword, for a period of time. And the third keyword, consideration. So the right to use an asset. So if there is no right to use an asset, then lease agreement or lease contract does not exist. 2, for a period of time. And 3, consideration, normally money. Normally it is money. So on the commencement of a lease, on commencement of a lease, the first thing you need to know is that on commencement you should recognize, the first thing is to recognize a lease liability and a right to or right of use of the asset. Yeah, and this is simple double entry. So on commencement of the lease, you should recognize a lease liability, that is the payment, and the right of use of asset, the assets you received as a result of that contract. So you recognize this liability and you recognize this asset as shown here in exchange for consideration. So the consideration you will pay becomes the liability, and the right to use this asset becomes the right to use this asset. So on the commencement you recognize 2, that's a lease liability and the right of use of the asset. A lease liability and the right of use of asset. There's a question here I will go through so you understand. So that's the recognition. So the first thing we need to know is initial measurement of the first principle, that's the lease liability. And initial measurement is the first thing you need to know. The lease liability is initially measured as the present value of lease payment that have not yet been paid. So the first recognition is present value of lease payment that have not yet been paid for. So if they give you a total of 3,000 and they tell you that 1,000 was paid, you subtract the 1,000 from the 3,000, then the 2,000 becomes the initial liability because you haven't yet paid for, so it is a liability. So initial measurement is the present value of payment. So if they are to pay 5,000 at the end of year 3, they will give you a discount rate of, let's say, 2%. So 5,000 at the end of year 3, discount it with 2% back to year 1. That is what you recognize. But they won't tell you to discount. Discounting is in financial management. So the first thing is present value, and in every question they will tell you this. present value of lease payment that have not yet been paid for. This is the figure. They will give it to you. The next thing you need to recognize in initial recognition is amount expected to be payable under residual value guarantees. That's all. Amount expected to be payable. So there is a residual value guarantee that the owner will say that at the end of the useful life, or at the end of that 3 years that I am leasing, or you are leasing this asset, I want at the end of that 3 years, I want the carrying value of the asset to be 2,000. So if at the end of that year the carrying value is 1,500, you are supposed to refund 500. But in most questions they will tell you that it was 200 below the expected value. So this 200 becomes a liability. We are looking for liability. So anything that takes money or economic benefit from the company is a liability. So the future payment that has not yet been paid is a liability. Amount you expected to pay under residual value guarantees is also a liability. The third one is a termination penalty. Why termination penalty? A lease is a contract. So if you are to lease it for 3 years but fails to fulfill that 3 year, there's a penalty. You don't calculate, they will just give it to you in the question. So that's all. Now we have initial cost of right of use asset. So the right to use the asset, we have to also recognize that. And the first thing is that's all. It's the same thing. You see, this one is a liability. That's for the payment. So the payment, so if the payment was 5,000, that's actually the cost of the asset. Double entry principle. Economic benefit is leaving. So you are paying 5,000, right? And the 5,000 you are paying, you are receiving an asset to use. So the 5,000 will also be debited as an asset. So the 5,000 here will be the same 5,000 here. So the initial liability, so the present value of the lease payment that have not yet been paid for, the amount expected to be payable, and the termination penalty. When you add them, that one is the initial measurement for the lease liability and the initial cost of the right of use of asset. Have you getting me? So what you get here is what comes as the first procedure here. So in most questions, the only thing they will give you is this one: present value of lease payment that have not yet been paid for. So this figure is what you will use to calculate for the right of use of asset. So the first step is this, and the second step is lease payment made on or before commencement. So if commencement was 1st January, let's say 1st February, any payment on 1st February or before, that's January, should be included in the initial cost of right of use. But any payment after 1st February, that's from 2nd February till should be ignored. So any payment pertaining to the lease contract made on or before commencement should be also included. So in the question where they give you this lease payment, what you will do is that you add it to the initial measurement. You add it to the, and you have any direct cost. In financial liabilities or financial instruments, direct costs are deducted, but in lease, direct costs are added. That's the cost of agent, commission, and whatever. They are all added, right? They are all added. So any direct cost associated with the lease. Now let me go to the main problem of students. That's student problem. Subsequent measurement. Subsequent measurement. Subsequent measurement. Subsequent measurement. You see, after we have recognized this one is recognized at the beginning of the lease term. These ones are recognized at the beginning of the lease term. But this one, we want to know how much we pay every year. So if the lease is for 5 years, we want to account for what every year goes into the lease agreement. Are you getting me? So we have two types of accounting for this because lease entails a lot, and lease deals with payment. People have cash flow problems, others don't have. So those that have cash flow problems pay in arrears, and those that don't have cash flow problems pay in what? Advance. So in the question they will tell you that beginning of the year or commencement of the lease agreement was 1st January and the year end is 31st December. So in the question they may tell you that payment is made in arrears or payment is made in advance. Are you getting me? But in a case where they don't state, they will tell you that payment is made on 1st January every year, meaning that 1st January is when they commence the lease agreement. So if it is paid 1st January every year, then it means it is advance. But if they tell you that payment is made 31st December every year, that is at the end of the year, then it is in arrears. You have to know the date. So if it is at the beginning of the year, it is in advance. If payment is made at the end of the year, it is in arrears. That's all. So let me show you the setup. So payment, the first thing you need to know is the payment in arrears. So the first thing here, you bring your years, you bring your balance brought forward. Okay, then you bring your implicit interest rate, then you bring your payment, then your balance carry forward. That's all. So this is the setup. This is the setup. So the years, year 1, and normally it is for 2 years. If so, the balance brought forward is what you got here, the initial measurement of the lease liability, everything here, the right of use of asset, after you added them. But in most questions, this is the only thing they will give you to you, the present value of the lease payment that have not yet been paid for. So they will tell you that, let's say the present value of the lease payment was 3,000, right? So 3,000. That will be your balance brought forward or your initial measurement. Your initial measurement becomes the year 1 first figure. So the 3,000 over here. And your interest, in the question they will give it to you that interest rate is, let's say, 5%. So your interest becomes this multiplying your 5%. And you add it to the balance brought forward because at the end of the year, the lease payment generates interest because the lease payment is subject to inflation and interest. So you add it to the remaining balance. And this payment is always negative. Why is it negative? In most questions, they will tell you that they make annual payment or rentals of, let's say, 500, meaning that every year they pay 500 for the lease. This is not what they pay. This 3,000 is the lease liability, the total amount of the lease contract. But the question will state that though the amount is 3,000, but every year they make annual payment of 500. So this 500 will become a negative figure here. So you look for your balancing figure. So this plus the interest minus the payment. I put plus there because the payment is negative. So minus the payment. So this becomes your brought forward figure. So in year 2, the carry forward figure become your brought forward figure. So when they ask you for what figure to be shown in the profit and loss as finance cost, it is this figure. For year 1, it is this figure, 150. But if you are preparing the statement of financial position, you need to split the lease liability into current and non-current liabilities. So our interest, this multiplying by our 5% here. Our payment constant over here, they make annual rental payment. So negative 500. We add them. So now you want to know our non-current liabilities. So this figure is your non-current liability. This figure here is your non-current liability. This figure is your non-current liability, and I'll show you why. Now your current liability is the year 1 figure minus the year 2 figure, balancing figures. So this is your current liability. The logic is that this is our non-current liability. That is the year 2 figure, because this year 2 figure is what will be carried forward to year 3 over here. This figure is what will be carried to year 3, year 4, year 5 if it is for 5 years. This figure will be carried to year 3, year 4, year 5. And it is more than 1 year, so it is a non-current liability. So the current liability is from year 1 to year 2, that is 1 year. Remember, current liabilities are liabilities within a year. So this year 1 figure minus the year 2 figure, from year 1 to year 2 is 1 year. So this year 1 figure minus the year 2 figure will give you the current liability for that 1 year period. So for that 1 year period, this was our liability. And this figure will be taken forward, or will be carried forward in the subsequent years. So it becomes a non-current liability. So if you are to prepare for 4 years, or if you are to prepare for 3 years, this one, if you are preparing for 1 year, you have to do year 2 so that you know your current liabilities. But if you are preparing for 3 years, this multiplying our 5% over here, our constant 500, we do our mass. Are you getting me? So now our non-current liability is this figure, and our current liability is the year 2 minus the year 3. So year 2 to year 3. So in year 4, this year 3 figure was carried forward. So this is our non-current liability. That's all. But in most questions, they will ask you to do for 2 years or 3 years. So this becomes our non-current liability, and this becomes our current liability. That's all. So in the question, 1st January X2, and they are telling you to prepare the financial statement for 1st January 31st December X2. It is approximately 1 year. So your finance cost, year 1 finance cost is this interest. But your current liability, you have to do for year 2 in your current liability is this figure, the year 1 minus the year 2. Your non-current liability is the year 2 workings that you had. That's all. But if it is for 2 years, you do an extra one like I did before, then you do the same thing. So it is always the previous year minus the current year will give you the current liability, and the current year's figure is the non-current liability. So I think that's all for the payment in arrears. Now we have payment in advance. And mind you, if the question tells you payment in arrears and you use payment in advance formula, you're going to get it wrong, because both of them gives different answers and the formulas are very different. So years balance brought forward, then you have your payment. This time around your payment comes first because the payment was made in advance. This one, the payment is the last thing because it is made at the end of the year. But in advance, the payment is made at the beginning of the year. But the interest is always paid at the end of the year. The interest, we account for interest at the end of the year. So, but this one is a fixed payment. You see, they tell you that they make annual payment of this. So this payment is actually fixed. So that one they can pay it in advance or arrears. But the interest payment is always paid at the end of the year. So in this case, in the payment in arrears, the payment is made at the end of the year. So the interest will come before the payment. But the payment in advance means that they made payment before the year end. So the payment will come before the interest. So the payment, you now have your subtotal. So when you have your interest, then your balance carry forward. The logic is that the subtotal here means that this year is our lease liability. So when we pay, let me show you. So year 1, we are using the same example. The present value of the payment is 3,000. And payment is our normal 500. It's fixed, it's constant, so our 500. So our subtotal is this minus this one. That's 2,500. The reason being that is that this is our liability we haven't yet paid for. But at the beginning of the year, we paid this. So at the end of the year, it is 2,500 that we have in outstanding. So then we apply the rate on the outstanding figure. That's all. So our 5%. Then we add it. That's all. So we want to know our current liabilities. Then we do for year 2. Year 2 balance brought forward figure becomes the carry forward for the previous year. Our payment is constant, which is 500. Then our subtotal, our interest is this multiplying our 5% here per the question. Then our balance carry forward is our subtotal plus our interest. So this is our non-current liability, and our current liability is year 1 minus year 2. It's our current liability. So this one, current liability, so this one, current liability, this one is current liability and non-current liabilities. That's all. That's all you need to know about leases, accounting for leases. That's all you need to know about accounting for leases. Yeah, I like to color my words, so you know what I mean. So I like to highlight them. Okay, so that's all. So that's the subsequent measurement. That's all. And the next thing we have is low value or low life assets. Those are exemptions. So low value are exempted. Imagine calculating for lease of a phone. It doesn't even make sense. We don't lease a phone. It's a low value asset. So phones, laptop, printers, those office equipment are not leased. We lease assets that can be capitalized. We don't capitalize mobile phones. So we capitalize furnitures, we capitalize buildings, we capitalize motor vehicles. Those are included in the lease calculations. But if you see any telephone or any laptop or whatever, please expense it into the statement of profit and loss account. Please expense it into the statement of profit and loss account. Expense the full figure. Don't account for lease. And low life is when it is for 1 year period. So no matter if it is a building, even if it is a building and it is for 1 year, you don't account for lease. Lease is for more than 1 year. If it is within a year, then how can you even account for the lease? So that's all. The remaining is up to you to read through. Then we have sales and lease back. We have sales and lease back. And this sales and lease back happens when there's cash flow problems. It happens when there's cash flow problems. That's the sales and lease back. It happens so what they do, they sell their property and lease them back. I have questions I would like to show you. So that's all about leases. That's all about leases. Okay, that's all you need to know about leases. And with the leases, we capitalize the asset. Are you getting me? We capitalize the asset. But if it is not an asset and it's a low value asset, we just leave it like that. We just leave it like that. So let's go to this question. This question says that on October 20X, Fino entered into an agreement to lease 20 telephones for each team of sales staff. The telephones are to be leased for a period of 24 months at a cost of $240 per telephone per annum, payable annually in advance. The present value of the lease payment at 1st October 20X is 9164. How much would be charged Fino statement of profit or loss for the year ended 31st December in respect of the telephones? So the question I've even given it to you. Lease payments are not recognized in profit and loss. They are recognized in the financial statement. So this one is saying that it will be recognized in profit and loss, meaning that it is a low value asset. And here telephone is a low value asset. Even iPhone or laptop is a low value asset. How much more a telephone? A telephone is a low value asset. So in question 1, so the whole figure of, and here they said that the present value of the lease is 9164. So 9164 should be expensed in the P and L. That's all. This whole figure. Remember our initial recognition here. Present value of lease payment. And here the question is saying that the present value of the lease payment. So the figure is 9164. So this whole figure will be expensed in the profit and loss because the telephone is a low value asset. 2. What will be the carrying amount of the right of use of asset? And here on April 1st, 2007, Fino entered into an agreement to lease an item of plant from the manufacturer. The lease required 4 annual payments in advance of 100,000 each commencing on 1st April 2007. The plant would have a useful life of 4 years and would be scrapped at the end of this period. The present value of the total lease payment is 350,000. The present value. So the initial recognition says that it is the present value, right? So here we are looking for the carrying amount of the right of use of asset. So the first thing we need to know is our carrying value, our present value of the lease payment of 350,000. So 350,000. Now, what we need to know is that when we recognize this, the plant will be capitalized as 350,000. That is, it is equal to the lease liability plus the initial payment. It is equal to the lease liability plus the initial payment. Are you getting me? And this one will be depreciated. This one will be depreciated over the useful life of the asset. It will be depreciated over the useful life of the asset. And here, lease liability will tell you that, or in recognizing right of use of assets, we depreciate lease lower of useful life or lease period. So in this case, this statement here means that in the question they may give you the useful life of the asset and the number of years the lease agreement is supposed to last for. So the two figures, the one that is lower, that is what you have to use for your depreciation. So if the useful life is 2 years and the lease period is 3 years, you depreciate the asset for 2 years. But if the useful life of the asset is 5 years and the lease period is for 4 years, you depreciate the asset for 4 good years. For 4 good years. So let's go to our question. Our question says that the plant will have a useful life of 4 years. But here they didn't give us, so it will have a useful life of 4 years. That's the plant, that's the lease years, but it didn't give us the lifespan of the asset. So 4 years. So our 350,000 divided by our 4 years. So we have our 87,500 a year. So our depreciation is 87,500 a year. So the carrying amount of the right of use of asset is 350,000 minus 87,500. But this figure here is wrong. Do you know why? Because the question says that on 1st April 20x7, Fino entered into an agreement. But the question is saying that the carrying amount as at 30th September 20x7. So it is for a 6-month period, not a 1 year period. So what you will do is that this is your 350,000 divided by the number of years, 4, meaning that for every year you charge this. But this 87,500 is for full year, and here we are looking for from April to September, that is 6 months. So 6 divided by 12, the 6 months over the 12, that's you prorate it, multiplying your 87,500, that's the full year, that's 43750, or this divided by 2, 43750. So now your carrying value of the asset is 350,000 minus the prorated depreciation, 3652. That's all. That's for the right of use of the asset. Okay. Now 3 is saying that what interest will be charged to Fino statement of profit or loss for the year ended 30th September 20x7 of the plant lease. And here is the plant lease. But still bear it in mind that the plant lease is halfway through the year, from April to September, that is 6 months. So on April, Fino entered into an agreement. So here they say that the lease required for annual payment in advance. So here payment is made in advance, and we have to look for what? Our interest, and payment is made in advance. So we set up our workings. Our workings over here, payment in advance. So we set our workings. So years our balance brought forward, and the payment was made before the interest. So payment subtotal interest and your balance carry forward. So year one, the balance brought forward figure is the present value of the total lease payment, 350,000. Payment is an advance for annual payment. It's constant $100,000. So you subtract 100,000. So you do your math. So the subtotal, now the interest, they say that the interest is what, 10%. So this multiplying 10%. So your balance carry forward is the subtotal plus the interest. But this interest here is wrong. You know why it is wrong? Because we are doing from April to September. So this interest is also for year one. So for 6-month period, that is this divided by 2. But the question says that only the interest rate. So this 12,500 will be your P and L figure. So what interest will be charged to final statement of profit or loss for the year ended. So your P and L figure will be this, the interest multiplying 6 divided by 12,250. So your balance carry forward figure is supposed to be your subtotal plus this. That's all. So because it is for half month, but if it is for full year, then just be this plus this. Then year 2 is this figure, your negative 100,000. You do your math. Your interest is 10%. This plus this. So this will become your non-current liabilities, and this minus this becomes your current liabilities. That's all. That's all. Telephone is a low value asset, so it need not to be even capitalized in the first place. So you have to expense the full figure. That's all. Another question. Another question. The first one says that what will be the finance cost in respect of machinery? And here's the machinery. On 1st January, entered into an agreement to lease a new machinery under a 5-year lease with 300,000 payable on 31st December each year. The asset has a useful life of 6 years with 300,000 payable on 31st December each year. And when the agreement started, 1st January 2026, and payment is made on 31st December each year, meaning that payment is made in what? Arrears. That's all. So you know this and you know P's. So what will be the finance cost in respect of this machinery? Payment is made in arrears. So yes, balance brought forward. Payment is made in arrears, so your interest will come before your payment. Then your balance carry forward. So year one, you are looking for just the finance cost in the profit and loss account as at 31st December 2026. So on 1st January 2026, so it is for 1 year. So what is the lease liability? And the present value of the lease payment is this, 1,263,000. So 1,263,000 is the lease liability. The interest rate is 6%. So one is just requiring you for the interest payment. So This should be your answer. No need to break, but the payment is made in arrears, 300,000 payable, so negative 300,000. And the balance carry forward is this plus this minus this. That's all. Now 2 say that what current liability to the nearest thousand will be recorded in the statement of profit and loss. You see, this one they are asking for your current liabilities, and I taught you in the earlier lectures. So your current liabilities is so simple, straightforward. After you have done for the year 1, your year 2, you have to do your year 2 before you know your current liability. So your balance of forward figure is your balance carry forward figure over here, and your interest is this figure multiplying the implicit interest rate as above, that's 6%. 6%. And the payment is constant. Why? Because 300,000 payable on 31st December each year, and it is for 5 years, so negative 300,000. So you do your math. So this becomes your non-current liabilities, and your current liability is your year 1 figure minus year 2. From year 1 to year 2 is 1 year current liabilities. And here they are telling you that to the nearest thousand, so this one will be 238,000. 238,000. That's your answer. Okay, so this is your current liability, and this is your non-current liability. So that's all. And now the 3 is telling you that what is the carrying amount of the right of use of the machine of the asset. The carrying amount. So anytime you hear carrying amount, you have to hear of depreciation. And what is the machinery? The machinery is under a 5-year lease term, payable in arrears, but the asset has a useful life of 6 years. And what did I say here? I said something over here that we have deleted it, that we depreciate it. Here is here, lower of useful life or lease period. So here, so anytime you hear carrying amount of the lease, you just know depreciation. And here the lower of what? Lease period, or the lower of the useful life. The useful life is 6 years, lease period is 5 years. So carrying amount as at what? 31st December 2086. So for the 1 year, the carrying amount is the lease payment, that's the lease liability first. And how many years? The lower of the years, 5 years. 5 years. So our depreciation each year is this figure. That is our depreciation each year. So our carrying value is the lease liability minus the depreciation. So this is our figure. This is our figure. That's all. That's all. The same thing applies to this one. Here, what will be the carrying amount of the head office? Head office of each 20-year estimated useful life under a lease agreement. Here the years is only 1, so no lower of nothing. So here 20 years, and on 1st January 20X, the head office had a carrying amount of 10 million. So that 10 million divided by the 20 years. So the 10 million and the number of years is 20 years. So this divided by the 20. So the carrying value is this minus this, 9,500,000. That's it. 9,500,000. I think that's all. That's all you need to know about the leases. That's all you need to know about the leases. Nothing more, nothing less. There's another question here that is also simple and straightforward. Why? The question says that The present value of annual payment under the lease, excluding the initial deposit, 5,700,000. So the balance brought forward is 5,700,000. Okay, and the question is saying that with an initial deposit of 2.3 million and annual payment of 1,500, so there is an annual payment of 1,500. Annual payment of 1,500. But here payment is made in arrears on 31st March each year. On 31st March each year. And the thing started on 1st April. So the following year March. So in arrears, so interest. And here the interest rate is what? 10%. So this multiplying by our 10%. Now we bring our payment. Our payment is our negative 1.5 million. So 1,500,000. So our balance carry forward. Our balance carry forward is this figure. So your interest charge in the profit and loss is this. So year 1. So for year 2, your year 2, this figure, your interest, this multiplying 10%, negative 1,500,000. So this plus this plus this. So non-current liabilities. Current liabilities is year 1 minus year 2. That's all. That's all. That's all for the calculation. So everything plenty here has been summarized over here. That's all for your marks, and then you are good to go. You are good to go. So subscribe to my channel, and thank you once again.